welcome back after the break. The next concept. So far, what and all have we seen? Provision and contingent liability. Standard has one more component, which is what? Contingent asset. So you know contingent liability means what, sir? You can also know contingent asset. So here till now, somebody else was filing a case against us. This time we said, we will only file the case against somebody. Yes or no? Those are your contingent asset. Can you construct contingent asset ka definition, sir? They have not given there. Can you construct? Can you tell me? What will you write? One, it is a liability or asset. If you want, you can write this definition in your books. It is a probable asset. Meaning there must be more than 50% chance that this asset will come to you. It's a probable asset arising due to what? Arising due to past event again. Arising due to past events. Arising due to past events. And the existence of this is confirmed. The existence of this is confirmed by what? By happening or non-happening or not happening of a what? Of an uncertain future event. Of an uncertain future event. Is that uncertain future event in anybody's control? So of an happening of an uncertain future event not within companies or entities control. Not within entities. Not within entities control. So I've used contingent liability ka definition and accordingly constructed contingent asset ka definition. Contingent liability was an obligation. Here it's a probable asset. Otherwise everything is ditto. No change there. Yes or no? There you used to write what? They used to write possible obligation. Here you have to write probable asset. Meaning only if there is more than 50% chance that you will win the case, then only you will disclose contingent liability. If it's possible, then you won't disclose contingent liability. I'll give you a small table for that based on that chance. So far good, fine, sir. All right. This is the definition of contingent asset. Copying or done? Done. All right. So if it is virtually certain, meaning that if there is a more than 95% chance that you will receive that asset, then you can recognize it as an asset. If it is virtually certain, then we record it as an asset. If it is highly probable, meaning more than 50% chance, then we disclose contingent asset. Did you get it? If there is more than 95% chance that we will receive that asset, then you directly go ahead and you book it as an asset itself. If it is probable, meaning more than 50% chance, then you disclose it as a contingent asset. Else you need to ignore. Meaning the probability is 50% or lesser, then no need to disclose contingent liability. Ignore that and just move on. Think that it is not there and just move on. No need to recognize, no need to disclose anything. That is the funda of this contingent asset. Did you get the concept of this, everybody? Okay, now, can I go for the next concept, sir? If there is no doubt. Can I go for the next? Reimbursements. Before we get explain this, I will give you a small example. See if you have understood. See if you can understand here. Reimbursements. Suppose A Limited is a manufacturer. Let's say A is a manufacturer of cosmetic products. Your Fair and Lovely, Glow Lovely, blah, 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 that lovely. Those sort of products A is manufacturer. And A has sold the goods to B Limited, a retailer or a wholesaler, whatever. Is this okay? And B Limited will ultimately sell it to the customer. This is the process. Are we okay now? A Limited will manufacture the goods and he will give it to, or he will sell it to B Limited. B Limited will purchase it from A Limited and he will sell it to the customer. That is his business. Are we fine, sir? Okay. There is an agreement between A Limited and B Limited saying this is a cosmetic product. No? When you apply it on your skin, if there is any damage caused to any skin or any part of your body, then A and B have agreed that both of them will bear 50% damages. If any customer files a case or if any customer is asking any claim, then that claim will be set or claim will be paid by whom? B Limited will pay to the claim to the customer, but B Limited will collect 50% of the claim from A. This is their agreement. Is this okay with you? Fair enough. So if customer files a case against B, means B will pay to the customer and collect half of it from A. Yes, sir. Let us say one of the customer used this product and he got full, good day. So he used that Glow and Lovely product and his lal chehra ho gaya uska. Okay, full bubble type. And he filed a compensation for 10 lakh rupees. He filed a case. Fair enough. So B Limited ka lawyer told no point in going to the battle and all, settle it off, because all the evidence is suggesting that you will lose the case. Instead of going to the court, settle it off. Lawyer told off directly, if you come to me, unnecessary time waste. Fair enough. Anyway, we lose the case and you will lose money also. And settle, he told. Fair enough. Okay. B Limited told, okay, fine, we will settle. They're thinking about that, what to do. Okay. Now, what will B Limited do, sir? They have to pay 10 lakh rupees. Will they pay entire 10 lakh rupees from their pocket and leave it off, or they'll get some extra money? Or will they collect anything from A now? 50% of 10 lakh. 10 lakh of 50% is how much? 5 lakh rupees they will collect it from A Limited. Yes or no? Because that is what the arrangement is. Correct or no, sir? This 5 lakh rupees, B Limited, we are talking from B Limited here, okay? This B Limited is getting or paying this 5 lakh rupees. Are they receiving it or are they paying it? 10 lakh rupees they are paying to the customer. That is okay. We're talking about this 5 lakh rupees. Are they receiving it or paying it? Receiving it. This we call it as reimbursements. This, as per AS 29, we call it as reimbursements. Did you get the meaning of the term reimbursement? Meaning reimbursement is that amount which you will get provided if you settle any provision. If you are here, you are settling how much provision, sir? 10 lakh rupees. Because of that, you are getting 5 lakh rupees. Yes or no? Fine. This 5 lakh came only because of this 10 lakh. Yes or no? If this was not there, you would have received this 5 lakh. No. So that is your reimbursement. Reimbursement means if any money you are collecting because of settling the provision. Understood this? Fine. So what meaning of reimbursement is clear for everybody? That is your meaning of reimbursement. Second, what the standard says is reimbursement should be recognized only if it is virtually certain that you will receive it. Here, in this example, if B Limited is virtually certain, meaning there's more than 95% chance that B Limited will be able to recover this 5 lakh rupees from whom? A Limited. Only then they will recognize reimbursement as a separate asset. Are you okay? This is the point. So you can recognize reimbursement provided if it is virtually certain. Done now. And reimbursement should not be netted off with the provision. Here B Limited should make how much provisions, or how much they need to pay to the customer? 10 lakhs. So that means how much provision they need to make? 10 lakh. Recognize provision of 10 lakh separately. Recognize reimbursement as an asset of 5 lakh separately. Don't net them off. This is okay. Don't net off and show the individual amount. Show them separately. That's all is this particular provision. Any doubt you have, anybody? That's all you need to know. Based on this, I think we have one case study. We'll see it later. Meaning you understood? So tell me again, reimbursement means what? The amount that the enterprise will receive or collect on what? On settling a particular obligation. Can you record reimbursement as a separate asset? Yes, provided if it is virtually certain of receiving that. And can you net off reimbursement with provision, or it should be shown separately? Provision separately, reimbursement separately. So don't net off is what they have discussed. That's all is the provision. Can I go for the next one? Can I go for the next provision, sir? One or two more concepts are there and the standard itself is over. Main 90% of the case studies we have already done. Remaining things are chota mota stuffs. For your level, nothing else. Easy fellows. Yes, no? Next, can I go for the next one? Okay, next one is onerous contract. Okay, this actually is not there in a syllabus. I brought it off. Okay, but they've only used the term onerous. So why did you just keep it idle? I just brought in the extra concept also. And I didn't see this in your study material. But nonetheless, 2 minutes it will take, we'll explain it off. So onerous, if you remember, I mentioned this earlier already. AS 29 is not applicable for, if you remember the first line here, it's given. AS 29 is not applicable for executory contract, but except where the contract is onerous. Meaning for onerous contract, AS 29 applies. For executory contract, AS 29 does not apply. That's all is there in your study material. But just by writing onerous, we will not understand. No. So I've just tried to explain you in simple terms. Onerous contracts simply means loss-making contracts. Just write one line, that's all. Loss-making contracts, we call it as onerous contracts. Are we fine? So for onerous contract, that is loss making contract, AS 29 applies, meaning you have to make provision, okay, at lower of two things. Provision should be made at exit penalty or excess cost of servicing the contract over future benefits expected out of that contract. You'll compare these two and make the provision at lower of the amount. Just to get a little more clarity, I'll give you a small example. A Limited has purchased, or A Limited has entered into a contract with B Limited. A Limited has entered into a contract to purchase 100 units of X. A Limited has entered into a contract with B Limited to purchase 100 units of one product named X for 10 lakh rupees. This is a contract A Limited and B Limited have entered into. Fine now. Alright. Okay, A thought there is a good prospect for this product X, hence they enter into a contract. They have not yet purchased, they've just entered into a contract. And this contract has an exit penalty, meaning if you cancel the contract, you need to pay a penalty of 1 lakh rupees. That is what is built in the contract. Fine now. So far good. Okay, B Limited have already entered into this contract. After this, no, and A Limited is telling B Limited, supply me this goods after 5 months. Probably new guy, he's just starting out his business. He wants his 100 units of product X when? After 5 months. Is it okay? After 2 months, Corona lockdown happened. Now A Limited feels this was a very bad idea. Now if I buy this 100 units of product X, I can only sell these X or product X for only 8 lakh rupees. If I go ahead with the contract, because when will you receive the product 6, sir? After 5 months. Between only lockdown happened or many Corona and all happened. Now A Limited feels this was a very bad deal. Why? They can sell this products only for how much value? 8 lakh. How much did they purchase it for, sir? They are purchasing this product for, what is your purchase cost? 10 lakh rupees. But what will be your selling value or sale value? Sale value expected is only 8 lakh rupees. That means, will you make any profit out of this contract or you'll make a loss? How much loss you'll make, sir? 2 lakh rupees you'll make a loss if you go ahead and execute this contract. Yes or no? This is one. If you exit this contract, because you'll get this product only after 5 months, no? If A Limited sells, Macha will cancel the contract. Then B Limited will say, okay, you give me an exit penalty of 1 lakh. What AS 29 says is, this is onerous contract. Why? Either ways, it's a loss making for you. If you execute the contract, 2 lakh rupees loss. If you go ahead with the contract, or rather, if you go ahead with the contract, 2 lakh loss. If you exit the contract, 1 lakh loss. Are we fine now? So such loss making contracts, we call it as onerous. And as per AS 29, we make the provision at lower of these two amounts. What is this 1 lakh? Your exit penalty. How much is your exit penalty, sir? 1 lakh. Or how much is the benefit, sir? What is the cost of getting into this contract? 10 lakh. What is the benefit from this contract? Only 8 lakh. What is the excess cost, sir? Excess cost only, we're calling it as loss. No. What is the excess cost? 2 lakh. So make the provision at 2 lakh or 1 lakh, whichever is lower. What is lower here? 1 lakh. So you have to make a provision for 1 lakh rupees. You don't have question based on this at your level. You'll study in detail about all this in your CA final. Just only one word has been mentioned about onerous. Just to explain that, I give you a small example. Is it better now? Okay. Just simply remember one thing, onerous contracts are nothing but loss-making contracts. You make the provision at lower of these two amounts. Can I go for the next concepts? Or anything you want to write down or you want me to wait? Forward march on. Okay, next. Restructuring. Restructuring means what, sir? Internal reconstruction, external reconstruction and all we have done. What does restructuring mean? Absence. What absence, sir? Nothing. Okay, what does restructuring mean, sir? What does restructuring mean? Changing something about business, yes or no? Internal reconstruction means internally you're changing, yes or no, sir? Here when they talk about restructuring, they're talking about what? Selling a particular line of business or closing down a particular division, or changing the management structure, or firing a few employees. All this we call it as what? restructuring. Are we okay? So for restructuring, should we make the provision was the next question. For restructuring activities, if any company wants to do restructuring activity, meaning if they want to shut down any operation or like sell off a particular division or fire a few employees and all, should we make a provision for that activities was a question. For that, they've specifically brought in here. Provision should be made for committed cost of restructuring. Provision should be made for committed cost of restructuring. And you can say that the company is committed to restructuring if a binding agreement has been entered into. If company has entered into an agreement for restructuring, then we say it is committed. And for such committed cost, you can make provision for restructuring. Like if you want me to give you an example. Let's say Air India. Have you heard about this airlines? Air India. Okay. Air India wants to do one restructuring. You know what they want to do? You know, in your aircraft, you will find air aunties and air uncles. Air hostess. Correct. Air India has air aunties and air uncles. Yes, no? Alright. Air India decided many people are not preferring their airlines because their hospitality is on the lower side. Is it okay? Because all their employees, they are looking at it as a job, no? All these employees are middle-aged employees. They're not able to service the customers properly. They're not interested. Their customer is asking for coffee and this person is getting something else. Okay. Alright. So the customers are basically not happy and it's a reality in fact. Many of them actually don't prefer the Indian Airlines or Air India Airlines because they feel service is not that good. We'll go for private airlines. Cheaper also, service also better. Correct? No. So this is the case. So Air India decided, no, actually too much competition is there. We are making too much losses. Hence, let's do restructuring. So we'll fire off all this air aunties and air uncles in a particular route. Let's say there are about 10 routes. Bangalore, Bombay route, Bangalore, Delhi route, like this. In these 4-5 routes, no, they want to remove off, fire these employees and bring in the new young generation, young blood they want to bring in as air hostess or whatever, air uncles. Fine, now they want to bring in the new folks so that they can improve the service and accordingly improve the revenue. Fine, now this is their idea. Sir, can you directly tell those people directly? They have served their organization for so many years. Can you one day tell them, fired, okay, majamadi, you're free now. Can you tell like that to them? Yes. So what do you need to do, sir? You need to pay something known as severance pay or termination pay and all you will pay, no? Correct, no, sir? Because suddenly if you're firing them means you need to compensate them, no, sir? Let's say Air India told, I will give you 3 months salary. Sorry, due to unforeseen circumstance, I need to fire you guys. It is not working out for us. As a compensation, I'm going to give you 3 months salary. Please take 3 months salary and leave the organization with immediate effect. Or you will leave the organization from next month onwards. Like this, you gave a notice to them. Are we okay, sir? Now, can you tell whether this is a restructuring? This is a restructuring. One way it's restructuring only. You know, they are changing your business plan of operating. Correct? Now, all your employees, old employees, you are rotating or you're what? Churning out the old employees and bringing in the new young generations. Yes or no? So this is also restructuring. Is Air India committed to this restructuring? Because AS 29 says what? For committed cost of restructuring, you can make provision. Is Air India committed to this, sir? Yes, clearly they told what to the employees? I will give you 3 months salary and don't report to work from the next month. That means clearly it's been communicated to the employees. Yes or no? Let us say this 3 months ka salary comes to rupees 50 lakh rupees. All the whoever employees whom you need to fire, no? To all of them put together, this comes to how much? 50 lakh rupees. Is organization Air India committed to this? Yes. That means can you make a provision for this restructuring? Yes. Because organization is committed. Restructuring, though it's a future activity, there is a specific provision induced that you can make a provision for this. Overriding exemption for this. Manageable law. So that is what they have told here, sir. Provision can be made for committed cost of restructuring and you can say that organization is committed provided a binding agreement has been entered into. Fine, now that's all it is. So if that is the case, means you can make provision. Manageable. Alright. However, a restructuring provision should not be made for the following cost. One is relocation or retraining the cost. Let's say one particular employee is operating in Dubai. That employee from Dubai, you want to bring it to Bombay. That means from Dubai, he has to relocate to what? Bombay. That means there will be some relocation cost now. Suddenly, he can't find a house now. That means what? You have to call him. You have to bear his air tickets. Airlines is yours only, so it is okay. So you will bring him in free of cost. But what about your accommodation and all? Can he suddenly find off the house? Huh? Normally, when you're going outstation work, companies will give you what? 1 month. They'll put you in a hotel and say, all the expense I will bear. Within 1 month, after 1 month, you take care. Within 1 month, find your house. For this 1 month, I will bear this cost. That means there'll be some relocation cost and all. That and all is not related to your restructuring. They're specifically saying transfer it off to P&L. Now you find specific provision here. And if there's any marketing cost or investment in new system, for this, do not make a provision. Like Air India decides, I'm going to buy 100 new aircrafts because of restructuring. Fair enough. They want to expand and we want to buy how many? 100 more aircrafts for 10,000 crore rupees. Can they make provision for 10,000 crores? So for new investments and all, if you're planning to do it, please don't make restructuring specific overriding exemptions given. Called out. Is it okay? That's all about restructuring, sir. Any doubt or okay? Any confusion or okay with this? Yes. Last but one provision is future operating loss. I'm going to make a loss in the next year. Let's say at academy, we feel next year we'll make a loss. Assumption. Okay. All right. Next year we're going to make a loss of 3 lakh rupees. Assumption we are foreseeing. Can I make a provision for that loss now only? Why? Definition. What is the definition of provision? Present obligation arising out of what? Past event. So for future operating losses and all, will you make any provision? No provision. So that is what they've written. Provision should not be recognized for future operating losses. If they mention anywhere future operating loss, straight away, right? No provision required. That's all is the next concept. Contingent liability also as such, like, not required according to me. Yeah. Because anyway, these are, if it's major for your, disclosure, no standard will prevent you from disclosing, giving additional disclosure. Fine. Nobody says don't give it. Fine. But everything, if you start disclosing also, things will become hayward also. Hence, they may not disclose all this stuff. Fine. Generally, in director's report, they give you future plans. There you might just call out all this. Everything you need not call out in annual report. There are other things also where you can bring out information. Fine now. All right. Next. Last one is disclosure, sir. Can you tell me 2 disclosures we already learned? One is what? Contingent liability. Contingent liability, do we pass journal entry or do we recognize it or just disclose it? How about contingent asset? Again, only disclose. If you're getting any reimbursement, that also needs to be disclosed. If there's any restructuring cost, that also needs to be disclosed. And you need to give a reconciliation of provision, meaning from opening balance till closing balance, what and all happened. How much provision you made additionally during the current year, how much got reversed out, how much got utilized, that reconciliation also you need to give. Reconciliation from opening balance to closing balance. Reconciliation from OB as an opening balance to CB as in closing balance. You need to give. That's for the provisions. These are some disclosure requirement. Remember how much ever is possible. Disclosure is not that important, but just always, instead of skipping, good to know 2 or 3 points, just in case they decide to ask off. Manageable law. CL is contingent liability. CA is contingent asset. Third one is reimbursement. Fourth one is restructuring provisions. And then reconciliation from opening balance to closing balance. Those are your disclosure requirements. With this, all the concepts of what? AS 29 is we are done with. We have a few more questions pending. Let's knock them off one by one as well. I think we were done till what, 30 now? 12th. Maybe we'll finish off from the end now. First 2 questions, we'll take it later. Ulta organize, sorry. Okay, look at this question, sir. The company has not made provision for warranty in respect of certain goods, considering that the company can claim the warranty cost from the original supplier. You are required to examine in the light of AS 19. You remember that example I gave you, cosmetic product? What happened in that cosmetic product, sir? Here only example I had written. What happened here? A was what? Manufacturer. B was what? Retailer. What did the retailer do? He sold the goods to customer. If customer claims any money, then what will B Limited do? 50% of that money he will claim it back from A Limited. Yes or no? That only we called it as what? Reimbursements. Here, they're saying in this case study, what happened is this B Limited, for assumption, he's saying, I will not make provision for warranty because he's saying any which way I'm going to get it reimbursed from A Limited. 100% reimbursement is getting me. He's telling. That's the reason he's saying, I will not make provision. If he pays the 10 lakh rupees, he's saying entire 10 lakh rupees, I will collect it from the supplier. He has given a warranty, products given under warranty, entire money he will collect it from the original supplier. Hence he's saying, I don't have any outflow, hence I will not make it. Is his contention right according to AS 29? What does AS 29 say? Reimbursement should be separately recorded if it is virtually certain. Provision should be separately booked. Reimbursement asset also should be separately booked. Can you net off these two? So that means, is what accounting treatment decided by the company correct or incorrect? Incorrect. That is what you need to write as solution. Can we write it? Question number 13 ka solution, maybe you write down this. Question number 13. As per accounting standard 29, provision, contingent liability and contingent asset, reimbursements should be recorded. Reimbursement should be recorded as a separate asset. Reimbursement should be recorded as a separate asset. When can you record it, sir? Point number 1. When it is virtually certain. When it is virtually certain. Provisions and reimbursements. Provision and reimbursements should be separately recognized. Should be separately recognized and not netted off. And not netted off. Next point you write, in the present case, what is that? Company has not made the provision. Company has not made warranty provisions. As it is recoverable. As it is recoverable from whom? Original supplier, they said. As it is recoverable from original supplier. That's what has happened. What is the conclusion? Conclusion is accounting treatment given by the company is correct or incorrect? Accounting treatment given by the company is not correct as per AS 29 or AS 29 ka provisions. Those are your pointers. Can I? Right. This was question number 13. Okay, next we'll go for question number 14. Question number 14, I think we've already done. It's a repetitive question, I guess. Let's see. A Limited has entered into a binding agreement with XYZ Limited to buy a custom-made machinery for 4 lakh rupees. At 31st March 2018, before delivery of the machine, A Limited has to change its method of production. The new method will not require the machinery. You can underline that. The new method will not require the machinery order, and so it shall be scrapped after delivery. Do you remember doing this question? Yes. So you placed an order for that machinery. Suddenly you changed your product line itself. So because of that, they are saying what? Is this machinery required or it become worthless? So that means you'll scrap it off. You're not even selling it. You're just writing it off, scrapping it. The expected scrap value is also nil. So that means that machinery is so customized, made that nobody is ready to buy it also. So salvage value is also nil. How much you paid for that machinery, or how much you have to pay for that machinery? 4 lakh. Show the accounting treatment of machinery in its books. Sir, you remember intangible assets we already did. What is the recognition criteria for intangible assets, sir? FEB and cost measurement. For your PP, tangible asset also same recognition criteria. What are the two recognition criteria? FEB and cost measurement. You purchased a machinery, which is a tangible asset. You thought that you'll get benefit and you bought that asset. But now what happened? Are you expecting any benefit from this asset, or it's going to be scrapped? If there is no FEB means, can you show that asset in your books, sir? No. Entire 4 lakh will be done what? Will it be capitalized or will it be transferred to P&L? Entire 4 lakh will be transferred off to P&L. Manageable. So the machinery will not be shown in your books. Entire 4 lakh expenditure will go to P&L. That is first observation. Is it clear? Have you already paid this 4 lakh to that vendor? Probably not, because you have not yet taken the delivery of that machine. No. Can you tell the vendor, no, I won't pay you and all, or you have a liability to him? You have a short shot, not a provision. You have a liability only here. Yes or no? Because what? It is virtually certain. No. Fine. Yes or no? You have to pay. There is no probable, possible and all. You have to pay him only. How much? For provision and all, there is an estimate. Here you have to estimate, or you know the amount only. Clear cut amount, you know how much you need to pay to the vendor. 4 lakh. That means no provision. Make book what? A liability itself. In this case, A Limited should recognize a liability of 4 lakhs. If you want, what is the definition of provision? You tell me, sir. Present obligation arising out of past event. Third is what? Probable outflow of economic resource. Liability ka definition is also same. Listen to this. Present obligation arising out of past event, which results in outflow of economic resource. No probable and all. 100%. That's all is your definition of liability. If you want, have they written? No? They have not. Or is it written in your book first page? I think somewhere I had mentioned. Check. Liability. Here it's given. Present obligation arising out of past event, which results in outflow of economic resource. For provision, you need estimates. Probable and that. For contingent liability, it is possible. For liability, it is virtually certain. Meaning more than 95% chance or 100% only. No? That's the distinction. Easy now. Guys, okay. Now coming back to this case study, sir, do you have what? How much you need to pay to that vendor? 4 lakh. That means you need to book what? Liability needs to be recognized for 4 lakh, and that entire 4 lakh will be transferred off or will be expensed off to what? P&L account. That's what they're saying here. A Limited should charge the amount of 4 lakh rupees to P&L account. Underline this, sir. This line you underline, and liability ka line you underline. Second point. In the given case, A Limited should recognize the liability of 4 lakh. Those 2 points are good enough for us. Rest everything is goalie. Why not? If you want to add more masala, what you can write? Asset should not be recognized because there is no future economic benefits. And liability should be recognized because liability ka definition is so and so. Fine now. That 2 more points you can bring in if marks are on the higher side. If it is 2 marks, these 2 pointers are more than sufficient. You want me to give you those points, or is this okay? Got it. They're saying got it. Fine now. Sure. All right. If you have got it, then can I move on now? Can I move forward? All right. So let's look at this now then. Question number 15. An engineering goods company provides after sales warranty of 2 years to the customers. After selling the product, they've given warranty period of 2 years. Based on the past experience, the company has been following the policy for making provision for warranties. They're making the provision based on this particular policy. What is the policy is? For making provision for warranty on the invoice amount and the remaining balance period. What they are saying is, if the warranty period is less than 1 year, they will make 3% provision. The company has this policy like this. Warranty period less than 1 year means 3% provision. Warranty has more than 1 year means 2% provision. On this basis, this is their best estimated amount. Normally we used to say, no, make provision at best estimated amount. Here, this is how they are estimating the amount. That is their policy. It is fine. Manageable. Okay. The company raised the invoice, meaning they've sold the goods as follows. Invoice date is 19th January 2011. And how much was the goods? 40,000 worth goods you have sold. Next, on 29th January, you have sold 25,000. On 15th October, you have sold 90,000. Check what is the requirement. calculate the provision to be made for warranty under accounting standard 29 as on 31st March 2012 and also on 31st March 2013. They're asking you provision balance on 31st March 2012 and 31st March 2013. Both the years. Fine now. Also compute amount to be debited to P&L for 31st March 2013. We'll come to that. First, as on which date they're asking, sir? Solution. They have given any which way. Directly I'm just writing short question. As on which date? First. 31st March 2012. Okay, check, sir. As on 31st March 2012, how much sales have you made? October 2012. Sir, 31st March 2012 means what is your period, sir? Current year will be 1st April to, or the year will be what? 1st April 2011 to 31st March 2012. Yes, no? And the company is giving warranty for how many years? 2 years. 2 years. Yes or no? Now check, sir. There I've given 3 sales. Can I take 15th October 2012? Does 15th October 2012 fall within this period or next year? Next year. So that means, should I have to worry about this 90,000 for my warranty provision? No. How about this, sir? 29th January 2012. 29 January 2012, will it come fall under this year? This is 1 month before or 2 months before current year ka ending. No, you have sold. How much is the value of the goods you have sold? 25,000. Check. From 29th January to 31st March 2012. How many months, sir? From 29th January to current year ending. Months you calculate. January, February, March. January end you have sold. So February, March can I say? That means it is more than 1 year or less than 1 year, sir. This is less than 1 year. Yes, no. For less than 1 year, how much provision they are making this company, sir? 3%. What is the invoice amount? 25,000. So the provision will be how much, sir? Provision required will be what? Since this 25,000 ka sales was less than 1 year, your provision required is 3%. Okay, so far? Alright, check here, sir. You have sold the goods on January 2011 also. January 2011 means current year or last year? Last year. Doesn't matter. Check from 19th January 2011 till the end of the year you count. 31st March 2012. How much is the year, sir? 1 year, some months. 1 year, 2 or 3 months. Yes or no? I don't want the exact months. Warranty you are just giving for 1 year or 2 years, sir? 2 years. That means is provision required for this amount also, no? For 2 years you need to make the warranties. Yes or no? Correct. That means for this also I should make provision, no? Yes. So is it less than 1 year or more than 1 year? For more than 1 year, how much is provision required? More than 1 year. 2%. So what is the value of the goods, sir? 40,000. That means what is the provision balance? 40,000 ka you require 2%. Yes, no? That means provision balance should be what? This is what? 7,500 or 750. 750. And this will be what? 800. That means the provision required will be 1,550. 1,550 is the provision required as on 31st March 2012. Anybody having any sort of confusion? They have given, you don't have to copy here. Nicely only they have given. Check. Provision made is as on 31st March 2012, 800 plus 750, which is 150. Same thing what I showed already, they've written here. Good or confusion? Online? Good enough or doubts? Respond. Good. All right. Next, sir. First year over. Only 1 year they asked provision or next year also? As on 31st March 2013. Check, sir. How many sales we have? We have 3 kinds of sales. Now the year in which date? 31st March 2013. You sold this 40,000 on which date, sir? 19th January 2011. Count from 19th January to 31st March, sir. How much period? 19th January 2011 to 31st March 2000 is more than 2 years. Yes, no? It is more than 2 years. 2 years or 2 months or 3 months or whatever. I give the guarantee more than 2 years or only up to 2 years. Only up to 2 years. That means is a provision required for this 40,000. Should I have to make any provision for this 40,000 on 31st March 2013 or not required? Not required. Why? The period of 2 years has exceeded. So no provision will be made on 31st March 2013 in respect of sales amounting to 40,000 made on 19th January 2011. Why? As the warranty period of 2 years is already expired. They have neatly given. Yes, sir. Everybody. How about this, sir? How about the sales made on 29th January 2012? Count from 29th January 2012 to 31st March 2013. What is the period? 1 year 2 months. That means more than 1 year. So for more than 1 year, how much provision we make, sir? 2%. That means the provision will be what? 2% of the invoice value. How much is that invoice value? 2% into this amount, which is 25,000. All right. This is one provision. And you have one more sale. One more sale you made in October 2012. From October 2012 to 31st March 2013, you count. How much is that period, sir? Less than 1 year or more than 1 year? Less than 1 year. For less than 1 year, how much provision we need to make? 3% of what? 3% of the invoice value, which is 90,000. So this will be 90,000 or 3% of 90,000. How much is the value you're going to get here, sir? This is what? 250, so 500. So this will be what? 270, 2,700. Okay. So that means the total provision required is how much? 3,200. Have they got the same answer? Provision as on 31st March 2013 is 3,200. This is your first requirement. They asked you provision required as on these two dates, which we have got. That's all, or one more they asked, sir. One more requirement they asked is compute the amount to be debited to P&L for the year ended 31st March 2013. Sir, what is the journal entry for provision? Can you tell me? What is the journal entry for any provision? We've already done enough questions. What is the journal? Provision is a charge against profit. Because of provision, what will happen to your profit, sir? It will be same or it will reduce. That means the journal entry for any provision is what? P&L account debit to provision. Here, a provision is for a warranty, no? So you will write here provision for warranty. Manageable. First year, you have to make provision for how much value, sir? As on 31st March 2012, how much is provision required? 1550. Manageable. Guys, okay. All right. But, or if you want, I can do a ledger also. Provision for warranty ka ledger accounts. Sir, any provision will have a debit balance or credit balance. Check. Journal entry and tell me, sir. Check your journal entry and tell me. You're crediting provisions. That means obviously it will have what balance? Credit balance. So what is the opening balance of this provision, sir? Till last year, how much was its balance? 1550. That means you will write here by balance brought down. How much is by balance brought down? 1550. As on 31st March 2013, how much provision you require, sir? 3,200. That means what is this 3,200? Provision ka closing balance, which is 3,200. Is the ledger matching or there is a balancing figure? This side 3,200. This side also should be 3,200. Is it matching or there is a balance? How much balance? 1650 is a balance. What is that, sir? You are having a provision of 1550, but how much provision balance should be? 3,200. From 1,500, you have to increase the provision balance to 3,200. That means additional provision you need to make. How much? 1650. What is the journal entry to make provision, sir? I have given you the entry here. P&L account debit to provision for warranty. That means this 1650. No, you will write by P&L account. Arrived as balancing figure. Or you can write as 3,200 minus 1550, and amount to be debited to P&L in the current year is how much? 1650. That's all they've written here. Check. Amount to be debited to P&L is 1650. They have not done ledger directly. They've compared opening and closing balance and derived the answer. Closing balance required is 3,200. Balance available is only 1,500. From 1,500, you have to increase it to 3,200. So you need to make an additional provision of 1650. You can present like this only. Ledger not required. For your understanding, I draw the ledger. Present like this only in examination. This is good enough. So this question is okay with you all. Any doubt in the online sector? This was asked in your CA Inters. Your Chota brother, CA Inter, IPCC. Your Bada Bhai. Earlier it was known as CA IPCC. It has come there. Okay, they can ask. There's a possibility. Always go with the mentality that some question will be bounced. Which subject we don't know. It could be accounts, taxation, costing, or whatever. As a thumb rule, we always see that one or two papers will be little tricky in CA. Same thing what is there will not be given. Not that 100% paper will be tricky. 15-20 marks of paper will be little trickier. Meaning you need to apply, you need to think. It will not be very straightforward. How you are able to handle that 15-20 marks will dictate how much you will get on the remaining. If that 20 marks is freaking you out, then this 60 or 80 marks also you will forget it. You will not write it properly. If you're able to handle that well, then this 60 will go smoothly like this. To clear, they'll not make it difficult, but students will freak out and start writing what? They'll start forgetting things. Nervousness will happen a lot of times. They'll not be able to complete the paper. Because of that, they find it difficult to clear exams. Any which way, that's for another day. Is this okay? Next question now. New question. It is added in your new study material I have brought in here. If it is not there, check your WhatsApp file. It should be there. An organization operates an offshore oil field where its licensing agreement requires it to remove that oil rig at the end of the production and restore the seabed. Sir, oil and all you'll extract. Correct? No. You'll dig the oil when inside the ocean and extract the oil. That's how it works. Yes, no. So to dig out that oil, no, you'll construct oil well. Just like you have your oil, normal water wells, no. In the same fashion, you'll construct oil wells in the seabed, okay, in that sea area. Due to this construction, right, your coral reefs and all will get damaged. Your seabed will get damaged. So what generally the governments will tell such companies, I'll give you permission to extract the oil. Fair enough. But once you are done, let's say the permission was given for 10 years. For 10 years, company says you extract how much ever oil you want, dig it, it's fine. After 10th year, restore the seabed to its original condition. How it was, make it like that. Fair enough. Whatever damage you have caused, restore it. This we call it as decommissioning and site restoration cost. I think group 1 guys should be able to relate this. I had given you Vodafone example, tower. Okay, any which way. That is there in accounting standard 10. Group 1, don't have to worry about that. So is this what I said now, did it make sense to you? Is this okay? That's what is happening here. So this company has gotten permission to extract the oil, but they have to restore the bed to its original conditions once this activity is complete. 90% of the eventual cost relate to the removal of oil rig. They have constructed that oil rig. No, sir. Can they keep it in the ocean like that only? Can you make an oil and leave it off the well there only and leave it off? Or after the oil is extracted, what do you need to do? Remove that or dismantle that oil well and restore the seabed to its original condition. Yes or no? That is what they're saying. 90% of the cost will be related to removal of that oil rig and restoration of damage caused by building it. First, because they're building it, now they'll destroy means there'll be some cost. Right? 90% of the cost relates to that, and 10% arises through the extraction of oil. When they start extracting the oil, that also will cause some damage. To what extent they are assuming or they are saying? 10%. So that means if you are incurring 100 rupees as restoration cost, 90% of this, that means 90 will be towards or will be related to oil well, and 10 will be related to oil car damage. That is what they are telling. And their own estimates. Maybe they are expertise in that. They have expertise in that field. That's the reason they have allocated. Manageable. Can I proceed further? At the balance sheet date, the rig has been constructed, meaning oil rig you have already constructed. Fine. But no oil has been extracted. With reference to AS 29, how would you deal with this in annual accounts of the company's balance sheets? Basically, they're asking you, will you make any provision or disclose it as contingent liability or anything they're asking? I know question looks a little bhari, correct? No, actually it is not. Simple only. Go back to your provision ka definition. What is that? First is what? Present obligation. Obligation means company cannot escape. Can company escape from this or no way? They have to rectify it. They've constructed that oil well. Can they leave it as it is or they have to dismantle it and restore it? They have to dismantle it and restore the seabed. Meaning you will have to incur the cost. Yes or no? So present obligation, is it there? Yes. Arising out of past event. Or has the oil well already been constructed? Only if you construct oil well, then only you'll cause damage to the seabed. Yes or no? Have you already constructed oil well? Yes. So is it a past event? Yes. Third is what? Probable outflow of economic resources. It will be, right? Yes. You only have to repair the damage. So that means it's possible or probable. It's not like a court case where may or may not. Here, what is it? You only have to pay for the damage. That means possible or probable? Probable only. Is this okay? That means why can't we make liability, sir? Amount is not sure, sir. In case of purchase of goods, you purchase goods for 4 lakh from creditors. How much you need to pay? 4 lakh. Is there any variance in that amount or fixed? So you book liability. Here, do you know it? You have just constructed an oil well. You have to restore it maybe 5 years down the line or 10 years down the line. That means all this restoration cost will come now or after 5-10 years. Can you 100% share after 10 years it will be 5 lakh only or it could vary? That is the reason we don't book liability. We record it as a provision. Provision is also liability only, but with uncertain amount and uncertain timing. That's all it is. Are we fine now? So third condition, is it probable outflow? Yes. Fourth one is reliable estimate of the outflow. Can you make reliable estimate of the outflow? You're doing in that line of business means if you can construct oil well, can't you dismantle it and restore it? So that means you have expertise. You can reliably estimate it. Yes or no? So provision is required. Yes. For what percentage, sir? For 90%. Why? Sir, of the total cost that you have to incur, no, 10% is related to oil. Have you already extracted the oil or no oil is extracted? No oil is extracted. That means you need to make provision only for what percentage? Provision is recognized for the best estimate of 90% only of the eventual cost that relates to what? Removal of the oil rig. Fine now. And restoration of damage caused by building to it. These removal costs, no, we call it as DSR. It will be added to the cost of the asset. You'll study this in your group 1. Leave this portion. Fine now. Group 1 guys, you should be able to appreciate this. Others, this portion, it's okay for you. Not a problem. Leave this. Fine now. Okay. Next, or maybe if you require it after this one, I'll explain. How about 10% costs? Should I have to make provision for that? However, there is no obligation to rectify the damage that will be caused by extraction of oil. Why? As no oil has been extracted. Hence, provision is required. So, hence, no provision is required for the extraction of oil. Basically, for this 90%, make provision. For this 10%, no provision is required. That is all is the funda of this. Manageable. Okay. This, no, sir, if you want it. So, this cost, you'll make a provision. Normally, provision will be added to what, sir? It will be transferred to P&L, no? This provision, 90% provision will not be transferred to P&L. It will be added to the cost of the asset. What is asset here? Oil well. Why? It is a DAC. You remember a DAC at least? When we did intangible asset, I mentioned DAC. What is DAC? Directly attributable cost. It is like DAC. Meaning, if you say to the government, I will not do the damages. I will not repair my damages. Will the government give you permission to construct this oil well? If you don't construct that oil well, can management extract oil, or can that oil well function the way it wants? No, that means what? If you want to use that oil well, you have to compulsorily rectify this damage. So it becomes like a DAC. We don't call it as DAC, we call it as DSR, decommissioning and site restoration cost. That is there in your group 1. At least little bit do you understand? Hence, this cost will not be transferred to P&L. You make provision, but it will be added to the cost of the asset. Meaning the journal entry will be, what is the journal entry you normally pass for provision? P&L account debit to provision for DSR. Yes or no? So here you will not debit P&L. You will write asset account debit. What is that asset? Oil rig. Oil well is your asset. So you'll asset account debit to provision for the damages or whatever. Provision for restoration cost we can write. This is your journal entry you need to pass. Not required really for your account syllabus because you don't have accounting standard 10 in your group 2. You have it only in your group 1. Just in case you were wondering, I just gave that entry. Manageable so far. Okay. So this question is also done, or any doubts you have for me? Any doubts for me, or that's it? Done. Done. I think we went reverse, no? So there are a couple of questions in your study material. That was our first question number 1 and question number 2. Let's take that up now and quickly run through that. Come to question number 1, sir. At the end of financial year ending 31st December 2017, a company finds that there are 20 lawsuits. Not one. 20 lawsuits the company is facing outstanding, which have not been settled till the date of approval of accounts by the board of directors. The possible outcomes estimated by the board is as follows. They've given you various outcomes. How many cases are? 20 cases. In respect of the 5 cases, they are saying win percentage is 100. They say 100% we will win. That means any provision required? Or maybe one moment, hang on. I'll just give you a small table. It's given in the chart for your reference. If you want, you can write this. We'll discuss that when I do the charts as well, but just in case if you want it. You can write it or you can just check it is there in the chart as well. Either ways, it is fine. 1. Just instead of particulars, if you want, you can write case also. Or if you have already written particulars, leave it. Let it be. No problem. First, virtually certain. Virtually certain means more than 95% chance. For more than 95% probability, we call it as virtually certain. If it is virtually certain, on the liability side, you will actually book a liability itself. No provision, no contingent liability. Directly book liability. On the asset side, you book asset. Are we okay? Next, or maybe first I'll do it of a liability and then we'll figure out the assets. If it is probable, probable means more than 50%. If it is probable, then on the liability side, you book what? Provision. Next, if it is possible, possible means 5 to 50%. 5% to 50%. This is not there in your study material. This is there as per CA final syllabus, Ind AS, that I'm giving you. Just for your reference. Okay. Possible obligation means, for possible obligation, what do we do, sir? We disclose what? What do we disclose? We disclose contingent liability. So you can write it as disclose contingent liability. Last case, remote. Remote means less than 5%. If it is less than 5%, then you can ignore. You don't have to do anything, just ignore. That's all. You remember in one of the case studies that told remote, I told we have not discussed that. I'll take it, give you a separate table. This is that table. This is on your liability side, sir. Can we similarly fill on the asset side? If it is virtually certain, then you will book asset. If it is probable asset, then you will disclose. Probable means you will disclose what? Contingent asset. If it is possible, then you will ignore. If it is remote also, you will ignore. That's all is from the asset side, sir. This is your table. This will give you a fair idea when to book liability, when to make provision, when to disclose contingent liability and assets. Just for your reference. It's anyway given in the charts. Then can I come back to the question? Okay, come back to this question, sir. There are 20 lawsuits. In respect of 5 cases, what is it? Win percentage is 100%. That means should we have to pay any damage, sir? No, that means should we have to book any liability? Not required because we are winning. That means is there any obligation to pay? No. Should we have to make book provision? No. Disclose contingent liability? Nothing. Because 100% win chance. No. So you have to do anything for this? No. Next 10 cases. Win percentage is how much, sir? 60%. That means what is loss percentage? 40. That means there is a 40% chance that you will lose the case and pay the money. If there is 40% chance of paying the money means probable or possible? Possible. If it is a possible obligation, then will you make a provision or disclose it as contingent liability? Disclose it as contingent liability. Got it up? Yes, everybody. They're asking you in this case study, how much contingent liability will you disclose? Or how much provision will you make? Since the win percentage is 60, loss percentage is only 40. That means since the loss percentage is only 40, it is not probable. It is possible. Probable means more than 50%. Here loss percentage is only 40. No. That means it is possible. Yes or no? So they are saying loss with the low damages. There is a 30% chance that there is a low damages. And how much you need to pay? 1,20,000. There is a 30% chance that you will only be able to pay how much? 1,20,000. And then they are saying there is a 10% chance that you have to pay high damages worth 2 lakhs. Right now, so they have more than one permutations and combination. How do you disclose or how do you make provision or contingent liability? Is simple, sir. If you want it as formula, take the probability percentage. Take the probability percentage, multiply it by the loss amount. Multiply it by the loss amount, multiply it by the number of cases. That's it. This will give you either provision amount or contingent liability amount. Here we are booking provision or contingent liability. Contingent liability. That's all is your formula. Okay. It's not actually a formula there. Study material may not see this, but this is what they've done. This is what you need to do also. Is okay. Fine now. Because there will not be one outcome, sir. There could be many outcomes. Yes, no. On one case, you have to pay high damages. One case, another case, you may have to pay low damage. So when there are multiple probabilities, instead of using the plain approach, you use what? Weighted average approach. You give weightage to everything and do it. Manageable. Okay, can I calculate off for the first 5 cases? Or that for the first 5 cases, should we have to make any provision or contingent liability? For the next 10 cases. So we'll write that. For 10 cases, can you tell me, sir, by applying this formula, how much you need to do? 1. If you win, should you have to pay any loss? Not required. How much is the next? Probability percentage is how much, sir? For low damages, it is 30%. There is a 30% chance that how much you may have to pay? 1,20,000. Yes, sir. So take this. Got it? Yes. Okay. All right. And there is a what? Another 10% chance that how much you need to pay? There is a 10% chance that you have to pay 2 lakh. Totally, how many cases you have, sir? 10 cases. So multiply it by 10. So how much is this now? 30% of 1,20,000 is 36,000. 10% of 2 lakh is 20,000. So you totally have to pay a damages of 56,000 on one case. How many such cases are there? 10 cases. That means the total damages is 3 lakh or rather 5,60,000. That is the what? The amount of contingent liability for these 10 cases. Is this okay? Guys, okay. Or if you don't want to do like this, if you want to plainly apply the formula, you can do it like that also. What is probability percentage, sir? 30%. What is the loss amount? 1,20,000. How many cases are there? 10. Oh, it came off here. Oh, maybe I'll write off here. This side I'll write. If you don't want to do like this, you can also do like this also, if this is comfortable for you. Probability percentage is 30%. Loss amount is how much? 1,20,000. How many cases are there, sir? 10 cases. Again, probability percentage is how much? 10%. How much is the damages amount? 2 lakh. How many cases are there? 10 cases. Calculate this. How much it will be? 3,60,000 plus 2 lakh, which will be how much? 5,60,000 only. One and the same. Either ways you can do it. Whatever way is comfortable for you. Manageable. Either do like this. Find out the damage per case and multiply it by 10, or plainly apply the formula also. You'll get it. Either ways. At least one of the two you understood. Offline and online. Have you reached that zone already or going in still? Going in. What going in? Don't ask. Yes, no? No. Why are you degrading, sir? We know. Alapa. Okay. Next, can I read it further then? We have 20 cases, sir. For the first 5 cases we have done. For the next 10 cases we have done. So we have remaining what? For the remaining 5 cases, what is win percentage, sir? 50%. There is a 50% chance that we will win the case, and there is a 50% chance that we will lose the case also. 50% is what, sir? Up to 50% is possible or probable? Possible. So that means here it is what? Possible obligation or probable obligation? 50% it is. More than 50% is probable. Less than up to 50% it is possible. I've written here. No? Check. That's the reason I drew this diagram. More than 50% probable. 5% up to 50% is possible. So in this case, it is a probable or possible? Possible. For possible obligation, will we make provision or disclose contingent liability? Disclose. Win percentage is how much, sir? If you win, should you have to pay any damage? No. Next, check further. There is a 30% chance that you have to pay low damages. Worth how much? 1 lakh. There is a 20% damage that you'll have to pay how much? High damages of 2,20,000. That means, can you calculate the provision for me, sir? We'll do it off here only. For the next point number B, for the next what? For the next 5 cases. Same, apply blindly formula. What is that formula, sir? Probability percentage. For win percentage, there is no damage. Leave that. What is the loss percentage? 30%. How much is the damage amount? 1 lakh. So just take this 30% multiplied by damages amount. Can you tell me the damage? If I go again, it will start loading. How much is the damage amount in that question? 1 lakh. Okay. How many such cases are there? 5 cases. Yes, no. And there is one more 20% chance that you have to pay high damages. How much is the damages amount, sir? 1 lakh, 2,10,000. And how many such cases are there? 5 cases. Can you do this calculation? 30,000 into 5 is what? 1,50,000. And 2 is what? 42,000. 42,000 into 5 is how much? 2,10,000 again. That means this will be what? 3 lakh. 60,000. Got it, sir? Everybody, calculation is 360. Yeah. Therefore, but on both the cases, in all the cases, are we making provision or disclosing contingent liability? Therefore, contingent liability to be disclosed is totally how much, sir? Contingent liability to be disclosed is how much? In this case is 5,60,000. In this one, 3,60,000. So 560 plus 360, which will be 9,20,000. Check the answer. Have they told 920? Yeah. Final answer you just check. Disclose contingent liability of 9,20,000. They'll do it in their own way. You do it aram se like this. It's fine. Just copy of this formula. It will be easier instead of worrying too much. Copy off. Have you copied this formula now? Blindly apply this formula, sir. Suppose it was probable obligation. Then the same amount you would have made as what? Instead of disclosing contingent liability, you would have made a provision. Like here, instead of win percentage, instead of 60%, if this was 40%, then there is a 40% chance that you will win the case. That means there is a 60% chance that you will lose the case. Yes or no? If you lose the case, you have to pay the amount. No. More than 50% chance that you will lose the case. Yes or no? In that case, you will disclose contingent liability or make provision. Make provision. But here, you will disclose it as contingent liability only. In examination, in this question, we have done it as contingent liability. In examination, you may get it as provision case. Same amount, but you'll have to recognize it as a provision. If you do the amount calculation properly and show it, instead of provision, if you write contingent liability, full level knock off. Because disclosing something, accounting something is entirely different. Don't expect mark in that case. I did everything, sir. Only one word I missed. Nediala. Okay, because that word makes a huge difference. So watch out what do we need to create. Provision or contingent liability. Then only apply this formula. You will get this. Easy now. Can we go for the last question of this particular topic? Exoxa. How do I pronounce that? Okay. OX. Okay. E Limited. Simple. E Limited is in the process of finalizing the accounts for the year ended 31st March 2017. The company seeks your advice, the future chartered accountants, on the following matters. Goinda, na? No, why do you underestimate? The company's sales tax assessment for assessment year 2014-15 has been completed on 14th February 2017. GST, sir. Okay, now we don't have no CA, sales tax and all. You got the GST order you received. They did GST audit and they raised a demand. The officer raised a demand of how much? 2.76 crores. The GST officer is telling you have not paid GST properly and he's demanding extra money from you. How much? 2.76 crores. Whenever the demand order is raised, first you need to pay that demand. Then you can debate over it. You can protest it. This we call it as amount paid under protest. First you pay it and then you fight. It's like a legal battle. You'll fight with income tax department or the tax department. If you win it, they'll refund you the amount. Otherwise, they will say, tata bye bye. Anyway, you've paid, matter done. Like this. This is how it works with income tax. Fine now. So the company paid the entire due under protest without prejudice to rights of appeal. They paid the amount and they said we will go for appeal because we feel we have paid it correctly. Let's see. The company files its appeal before appellate authority. You'll have appellate authorities there. We learn in income tax. Wherein the grounds of appeal cover tax on additions made in the assessment order for only 2.1 crores. What does that mean? It became too much of tax, but still. How much demand the company, the income tax or the GST officer raised, sir? 2.76. How much did we pay? Since he has raised the demand, we have paid entire thing. We went for appeal. We are saying, no, we don't agree with you. We are going for appeal. But are you going for appeal for full amount or only 2.1 crores they're telling, sir? You are appealing only for 2.1 crore. That means you are only accepting what? 50 or 60 lakh, I have paid less. That I will not appeal. Fair enough. But this 2.1 crore, I will not accept with you. This is okay. That means you are saying liability. What is the difference between these two? Check. 2.76 and 2.1 crore. How much is that, sir? 6 lakhs or 0.66 crores, sir. Did you pay for it? Did you pay this 0.6 crores also? Yes. Are you appealing against this or you are accepting it as liability? You are accepting. Saying that you are saying, okay, I agree that it is my mistake. Have paid less. Fine, now you went through. So that means what is that, sir? Company is not appealing against an addition of 0.6 crores. If they're not appealing means it should be provided for in the accounts. Meaning you should book that entry as such. Correct? Now meaning what is the journal entry for tax paid? First you need to make provision, no? P&L account debit to provision for tax, and then you pay provision for tax account debit to bank. So basically account that 0.6 crores. Fine, now they're saying book it off in your accounts. The amount paid under protest. Did you pay any amount under protest? Yes, how much amount did you pay under protest, sir? 2.76 crores. That should be shown under loans and advance. Because you're paid under protest, no? And disclosed along with a contingent liability of 2.1 crore. How it became contingent liability? How much did you pay totally, or how much was the demand amount, sir? Demand amount was 2.76 crores. How much did you totally pay? Paid is also 2.76 crores only. Whatever you paid, no, you show it under loans and advance. Because you are going for appeal, no, sir. So that means it looks like you paid an advance money now. If you win the battle, you will get the money back. So it's like you have given loan to the income tax department or GST department. Show it there. Fine now. All right. Next, what is the difference between these two? What is the difference? Actually, here there is no difference. What is the protest amount, sir? How much did you go for appeal? Appeal you only went for 2.10 crores. That means what is the difference between the demand and appeal? The difference between the demand and appeal is 2.76 crores minus 2.1 crores. How much is the difference? 0.66 crores. Are you going for appeal for this or not going for appeal? Since you're not going for appeal, that means you accept that this is your actual tax amount. Provide for this, meaning book this as provision. Is it? Make the payment for this. You already paid it, book it as provision also for this. And now basically you can book it as tax liability only. First you will make provision for tax, then you will pay that tax. No. So you have paid the tax, make the provision, set it off. Deal done. That's what they're trying to say. Got it? That's what they mean by provide for this amount. Actually, this question is little tricky for your level, but still, okay, are you able to, little bit is going in now? All right, sir. So how much are you appealing against, sir? 2.1 crores. 2.1 crores. Yes or no? Sir, appeal means you should give the evidence. Yes or no? Necessary evidence you will produce. This is like your court only. But you're not going to the court, you're going to the GST department, GST officer, tribunal, appellate tribunal. You will provide the evidence. If that officer is happy with your evidence, he will say, okay, you win. Fair enough, we lose, you win. Take back your money. Are we fine? Suppose if he is not happy with the evidence, what will he say? No. We don't accept your appeal is rejected. Meaning we will keep the money with ourselves. You lose. So that means what this, sir? What about this 2.1 crore? Is this dependent on something else? Is this 2.1 crore ka settlement dependent on something else? Yes. It is dependent on what? That appellate authority ka judgment. Yes or no? Is that appellate authority ka judgment in your control or somebody out of your control, sir? Out of your control. Fine. So if you feel it is a probable obligation, then you make a provision. But the fact that a company is appealing it, if they have, when will they go for appeal, sir? Just like that, they'll go off. See, companies, you rationally think, all this will not be done by the company ka representative. All this will be done by chartered accountants. Appeal it. Okay. If company feels they will lose the case, will they hire chartered accountant, pay him the fees also and go for appeal and lose the case and come up? Why have they gone for appeal? Because they feel that they don't have to pay for this. That means obligation is probable or possible. Possible. That means this 2.1 crores, you have to disclose it as what? Contingent liability. That is what they've said here. Disclose along with a contingent liability of 2.1 crores. Did this go in, sir? Now, is it better? Yes, can you give me a quick summary of this? Oh, time up already. Okay, demand was raised for how much? 5 minutes. I'll take it if it's okay with you. Okay, demand was how much? 2 point. Entire thing you paid, no. How much did you appeal for? 2.1. That means how much you did not go for appeal? 0.6 crores. Since you are not going for appeal, meaning you are accepting that what? This is your my liability amount. So book, pay, provide for it as a liability or as a provision. It is fine. Good. How about this 2.1 crores, sir? You went for appeal. Then that means you may win the case or you may lose the case. But you have since gone for the appeal from the company. What does company feel? They have a strong case of winning the case. That means you need to make a provision for this or you need to disclose it as contingent liability. Contingent liability. That's the reason. Now, that is that question. This question has one more summary. Let's quickly do that also. The company has entered into a wage agreement in May 2017, whereby labor union has accepted a wage revision from June 2016. From June 2016, you are paying them revised wages. The agreement provided the hike till May 2017. From June to May, you are giving the hike. Fine now. But this hike will not be paid to the employees, but it will be settled at the time of retirement. You are telling those labor union, I will give you a hike in salary, but the hike I will not give you in terms of cash now. When you retire now, I will pay you the money. Now I will not give you the hike amount, I will only give you at the time of retirement. The company agrees to deposit this arrears in government bonds by September 2017. What do you need to do, sir? Provision or contingent liability or what? What is it? You are paying arrears from which date to which date, sir? This is not June 2017. Make it as June 2016. It's a typo from institute material. From June 2016, what does your year end on? March 2017. Because your year ends on March 2017. No. That needs to be provided for in the accounts for the company. You're providing more wages means, isn't it your salary, sir? Your salary, yes or no? From your current year is from 1st April 2016 to 31st March 2017. Okay, now. From June 2016 till the next year, May 2017, you have revised their wages. Revised their wages means you have given a hike. Fine. I mean, salary is the same or salary is increased? Salary, will you account it as expenditure or leave it off? Will you account that salary in the current year? Sir, increased amount of salary or leave it off? You need to account. That is what they are saying. Arrears for the period June to March 2007 are required to be provided for the year ended 2017. Meaning that is your salary, means book a journal entry for that. But we pay till May, sir. Sir, April, May comes in your current financial year or next financial year? Next year salary will you account now only? Yeah. You book it in which year? Next year. So basically you need to provide for this. Basically salary expense you need to provide, sir. That's all it is. Manageable. Yes or no, sir? That is what they are telling here. Okay, these are little fancy questions. I don't know why they really brought into your study material on this. Not ideally a good question according to me. Any which way, did you understand both of it? Alright, with this, all the questions relating to AS 29 is officially over. Thank you.